My name is Raju Patel. I'm here with Julio Dal Poz, who is in strategy and international portfolio for Statoil. Welcome, Julio.
Well, thank you very much.
You recently you were a panelist on the oil and gas panel at the GS event, and a number of points came out of it. And what I wanted to ask you today were a few questions around, the comments that you made.
Sure.
So the first thing I'd really want to ask you is, what was it about resource efficiency that struck you the most on that discussion?
For me, the most interesting point about resource efficiency was the point that was being discussed about management interventions that could lead to the most efficient extraction of resources out of oil and gas projects. And then management interventions in this sense, they range from the engineering side, where you could have lean designs, efficient designs on new projects, designs that are not only efficient, but they are flexible enough to account for all the uncertainty in this period. Going all the way to management of the supply chain, integrated planning, the logistics management for ongoing operations in the oil and gas industry. I think those management integrations, those management interventions, they are key to ensuring an efficient extraction of the resource. And also, I think something that's overlooked sometimes in the oil and gas industry is the impact that technology can have in this industry and on the efficient use of resources. And then technology impact can range all the way, again, from engineering innovations like innovative ways of drilling, for example, in the case of the shale gas or oil in the US, all the way to the use of data mining or data analytics techniques to ensure efficient management of any warehousing, spare parts, logistics, supply chain, and so on. So I think we are barely seeing the tip of the iceberg when it comes down to the use of data management and what we call big data for this industry. I think there's still a lot to come.
Yes.
And this can, I think that the biggest impact of this use of data can be seen, especially on the onshore operations, because whereas it's important on the offshore operations because of the big numbers involved,
yes,
it's particularly important on the onshore operations because the operation cycles are so much shorter than for offshore. The companies drill wells on a week or 10-day interval. Right. Managing the logistics, managing the delivery of sand, of rig parts, of any water for fracking, and doing that as efficient as possible could mean the difference between having a profitable project, profitable operations or not, especially now in this low oil cycle environment.
That's because you got tight, compressed time scales.
Yeah. The time scales are so much shorter. The number of wells that you are drilling in parallel are also much higher, much bigger.
Yes.
And being efficient is a matter of the companies operating, they are operating on the margin.
Yes.
And if they manage to drill well in 1 or 2 days, shorter than the previous guy, the other company, that could mean that they are going to be profitable and the other company is not. So, yeah.
So that's interesting. It's about length of time and being able to manage that rather than just directly managing a unit cost.
Yeah, it's about managing an operation, and that goes as well not only for the operations themselves, but also for portfolio management.
Yes.
I think portfolio management is another subject that's going to come now to the fore especially because of the lower price scenario, but it was something that the companies were already working on before. So being effective and being diligent on your project approval, saying no to projects that are either non-economical or at least that they are on the margin.
What do you mean by non-economical?
Well,
on the margin?
It's called projects that have higher break-even price than what you would desire. So For example, if you go back like 6 months ago when oil price was still hovering around $100 a barrel, the Brent price, if you approved a project that had a break-even price of $80 or $85, and that's a kind of, let's say, an offshore deep water development, for example, that's quite expensive to do. It takes several $billion of investment to actually implement. If you approve a project that had a break-even price at around 80, 85, okay, that didn't sound so bad, right? But then now that the oil price is closing into $65 a barrel, your project that you approved at 80, $85 to break even, now that doesn't sound so good. Even though the prices that you use today, that you see today on the market, are not really the price that you should be concerned with, because just developing those projects take sometimes a decade. And then when they start operating and so on. So you should be concerned about the price, not that you're seeing today on the spot market, but the prices that you think that you're going to see in 10 years' time. The projects that you approve today, most of them, especially if you're in early stage exploration and so on, but then if you approve the development of a new project today, you need to be concerned about the long-term prospects of oil and gas. That is an entire discussion by itself.
Do you think companies, operators are making knee-jerk decisions based on today's oil price? Because we see, for example, BP is accelerating its cost-cutting and redundancies. They've announced a $1 billion redundancy program off the back of this. So, the lower oil prices. What's your view?
Yeah, it's not that they are making some knee-jerk decisions based on today's oil price. I think some of those cost-cutting decisions, or shall we say financial flexibility decisions, they are probably overdue already. We're seeing a lot of cost inflation in the industry over the past 10 years. Costs for project development, for operations, for the suppliers, for drilling, everything. Cost has increased several fold, so threefold, fourfold, fivefold. So some costs have have risen tenfold over this 10-year period.
And the
ability of companies to produce oil and gas. So if you look at the average production for major companies like BP, Shell, Chevron, and even Statoil, on average, the production hasn't risen at the same pace. The production has risen a few percentage points, but it certainly hasn't trebled or multiplied several hundred percentage points. So, given an increased cost inflation in the industry, given a difficulty that companies have to increase their production faster than they had, the inevitable consequence is that the margins have been squeezed over this period. So this whole activity of cutting costs, trying to get a more leaner, more efficient operations, trying to manage your portfolio to exit worst performing projects and then reinvest in the procedures on your best projects. This is already overdue in a way. Statoil in that sense has been lucky because we have started this whole exercise of reviewing our technical efficiency program, our operating costs a couple of years before all the other companies.
And why are you 2 years ahead of the curve?
Because we foresee that the situation where we were in was going to be unsustainable. We were going to start a big investment period where we would need to build new projects to guarantee our future for the next decades to come. And we wouldn't be able to approve the projects and make them economical, and then it goes back to my point about making the projects as economical as possible. We wouldn't be able to make them as good a project, lower the break-even price that we had for our project if we hadn't pushed hard to be efficient, to cut costs, to review the concepts that we had for project development, to review and to make the projects leaner and more efficient and cheaper.
That tells me something about the culture of Statoil, that it seems to be a more nimble, more innovative, more on your feet thinking type organization, because one of the criticisms that's been leveled at some of the huge super majors is they're like super tankers, very difficult to turn.
Yep.
You know, when a decision takes a long time. So what is it about the culture of Statoil that actually promotes and allows this greater innovation, greater nimbleness?
I think oil companies in general are, like any big organizations, they are always more difficult to turn around.
Yes.
And the bigger the company, the worse it is to change direction quicker. And sometimes you need a crisis like a low oil price scenario that we're having now to actually trigger all the pent-up efficiency activities that you should have been doing before either way. I think the interesting thing about Statoil is that we went through a lot of changes over the past 10 years, all the way from the company being floated on the stock exchange in 2001,
Right.
through the merger between Statoil, which was a state-owned company, with Norsk Hydro, which was a pure private company in Norway, combining forces to create also the portfolio for Statoil Hydro.
Yes.
That was in 2007. In 2011, the company decided not only to change its identity back to Statoil,
Yes.
but also it went through a major exercise of reviewing not only its strategy, but its view of the market, but also the way that it was organized internally. And doing that review back in 2011, we created a flexible organization that enabled us to respond faster to some of our market trends, the way that we saw them, than maybe some of our peers.
Yes.
And the way that we are organized, so we have a few global units.
Yes.
So for example, you look at the global strategy and business development, we have a global exploration, we have a global marketing. Those global units, they enable us as well to cut across different regions, different business areas, and combine our forces to as a force of change,
Right.
to drive new initiatives. So the length of time and the lead time between identifying a new trend, identifying where the market is going, and executing a new strategy has shortened a lot with the new organization.
And I think this is the key competitive advantage. You know, this is the key competitive advantage for Statoil. You know, you are able to move very fast, and it's because of decisions that have been taken in prior years, a few years ago, to enable this to happen. I mean, the other interesting point for me was, besides this cultural issue, is that I understand that from a major projects perspective, the benchmarking shows that Statoil is doing much better than peers, much better than average than the peers. And I'm interested, what is behind the capital projects, the major projects? How is it that you are, according to the industry benchmarks, outperforming your peers?
Yeah, I think the key point about industry benchmarks is that they measure not only how the company plans on executing those major capital projects, but also on the final outcome of those projects.
Right.
And then there's still a lot of room for improvement even on our side.
Yes.
I think we do particularly well when it comes down to avoiding cost overruns and avoiding major delays on commissioning projects that we are developing. Part of that is due to the time that we take on planning, and again, a lot of room for improvement, because even though we are doing quite well, we think that we still take quite a long time, and there's always the search for efficiency.
Yes.
So there's something about planning up front and then trying to deliver first time right. I think that's quite important. Something that usually blows every budget and delays a major capital projects is the fact that the companies allow for a number of modifications after they have given their investment decisions for projects.
Right.
So you approve a project and then you start making revisions, and then as you make revisions and as you start ordering for suppliers to build your facilities and so on, then that builds up over the value chain, and that leads to delay, that leads to budget overruns. So by planning right, by trying to deliver right the first time, by not allowing a lot of revisions, by streamlining things, we avoid some of the cost overruns. And then on the delivery side,
so just before you move on to delivery, that takes a lot of discipline.
It takes.
And I mean, discipline in process, but also discipline in how you execute and implement that process. Because at the end of the day, it's a people business.
Yeah, it is. And you need a team, and that goes to the delivery side as well. You need a team of not only project managers, but also of technical people that are very committed to achieving the most efficient and project execution that we can achieve. And everybody's very concerned about those benchmarks. They're very concerned about comparing ourselves with what's going on in the market, and they're very concerned about our reputation as a project executor, as a company that is able to deliver those mega capital projects, and avoid wasting shareholders' money. By the way, delivering those mega capital projects or big capital projects, or however you want to call them, I think this is one of the core competitive advantages of major IOCs, major oil companies, as compared to the NOCs. Right. Even though the NOCs, they can contract a lot of this from suppliers, and then they can get the project execution outsourced. The competence, the ability to execute that in-house, and the ability to take the risk, knowing that you can deliver that within budget and within your timeline, is a competitive advantage that the IOCs have compared to NOCs in general. Sure.
But there's something specific that Statoil is doing, because the industry benchmarks are showing you are doing better than others.
Well,
I think the point that you made is individuals in Statoil are really committed.
Yeah, that's
Where
my
does
point.
that commitment come from?
We are aligning. I think we're aligning incentives. I think that's the key. That's a key point. The way that we measure our people's performance is based on two different dimensions. It's based on not only delivery, but it's also measured on behavior. Right. And we are aligning incentives all the way from the delivery of a capital project, all the way to the total shareholder return that we handle back to the market, to the shareholders, the dividend policy, and so on. So what we are trying to do is that we are trying to optimize our cash flow. We are trying to have a healthy cash flow that can cover our dividends, and that is linked through KPIs and through incentives all the way to the big capital projects. If we have a major slippage on a capital project, that will impact the bottom line immediately. And people are very aware of that link. Maybe part of that linkage and of that heritage and of that commitment comes from the fact that a lot of our workforce is still in Norway, and then there's still a strong link between what the company delivers and what the Norwegian state is able to achieve because of that. But we are trying to also to internationalize this notion, and we are trying to get the good things about this Norwegian heritage, and then we are trying to use that for our international operations. And I think that is a unique characteristic of Statoil, is that commitment to the bottom line results, and then the bottom line results in our case, they go to the Norwegian Sovereign Fund, they go to corporate tax, they go to the dividends back to shareholders, and most of our employees are shareholders anyway. Yes. So that commitment to the bottom line is an interesting thing that we are trying to use also across the business. So the challenge is, how do you take best practice from one place and how you apply them to other place? And we are going through that process. So the feedback loops and the feedback learning, and using the best practice from one project, trying to reapply it on the other project, seeing what works and what didn't work. Also accounting for the uncertain environment that we are operating right now. That's what I'm saying. Several of the projects in Norway, they were built to demand very low maintenance because of the very harsh environment in the Norwegian North Sea. Yes. But they were very expensive to develop. Right. If we go to milder climates, maybe we don't need something that's so robust, yes. And also because there's so much uncertainty, maybe we don't need to a facility that will last for 50 years. maybe we can build it on a more flexible way.
Yes.
We can use a linear concept, a concept that allows us for some optionality. And then, depending on where the oil price and the industry environment go to, we can replace this concept, we can use something else. It is this flexibility, it is the link between using the best practice, using the heritage, and achieving flexibility given the uncertain world that we are trying to achieve.
Trying to leverage, yeah.
It is a challenge, but
yeah.
we are going through this period, and the internationalization of the company has helped in the sense of pushing people also out of their comfort zone and thinking about innovative solutions. So that is an interesting characteristic of Statoil and of the time that the company is going through as well.
Interesting. And then I wanted to pick up on the point around, with the cost-cutting trend that we see now, accelerated by the sharp decline in the oil price. I think 40% in 5 or 6 months.
Probably more.
More, yeah. So we are at, as you said, already at $65 barrel for Brent crude, and it's likely to go even lower. I mean, some analysts are saying as low as 60 as well. So what does that mean in terms of cash flows, operating cash flows and shareholder return?
Well, what it means is that companies need to be more disciplined than ever on focusing on the bottom line. And my previous point that we were ahead of the curve when it came down to looking for efficiencies, cutting costs on our operations, managing our portfolio to what we call to high grade it, so exiting some projects that didn't have as bright prospect and reinvesting the procedures into.
But this is making decisions fast.
Yeah, it's about making decisions faster, and it's also about making decisions earlier as well.
Yes.
We were ahead of the curve, and that helped because, for example, if we were going to manage our portfolio now, if we were trying to sell some of our projects today on today's environment, it would be so much harder, because then the difference of perspectives in terms of where the oil price is going to be will make any sale much more difficult than before. For the companies that haven't done that, now they're trying to catch up. Yes. So you mentioned BP cutting costs. We've also seen ConocoPhillips saying that some of the capital investment is going to be 20% lower than before.
Even Shell is...
The explorers, especially the European explorers, are also not doing very well, and the share price is very depressed.
We got the NOCs as well that are
the NOCs
starting to struggle.
are also very concerned with, and the NOCs, some of the Asian NOCs in special, they made huge investments, acquiring assets at the peak of the price, and now they're seeing that some of the value of those assets is probably going to be eroded because of lower oil price environment, because of low demand. So it's about being disciplined on the decisions that you make. So if you have a point of view about the future industry scenario, not necessarily about future prices, because we are as good as anyone else to forecast the oil price. Who knows what it's going to be? Yeah. But it's on the sense of foreseeing that there is a profitability challenge, and companies need to get better at improving their margins. That was our point of view when we started our effort to cut costs and to get leaner, and also to search for a way to lower the break-even price needed for our new projects. And I think that is the key point. If you are comfortable with a break-even price of $80 when the oil price is at 100,
yes,
that could be fine in the short term, but you might struggle along the way. Yeah. If you try to lower it and try to make it as efficient as possible, you make yourself more robust to the cycles that the industry goes through. And then that's the point about robustness in the portfolio, robustness in projects, robustness of the workforce as well. So if you have a flexible workforce, if you have a lean workforce, you can withstand some of the.
What does that mean? Flexible workforce, lean workforce.
Yeah, it's about having, and it's about not having more people than you need, not having buffers of people, sometimes doing tasks that are not directly linked to your core activity. So a lot of people in the back office, for example, and then when it comes down to a lower price scenario, crisis, or cutting costs, oh, we need to get like BP. I think the bulk of their cost cutting is probably going to take place in their back office, in their back office functions, which can cause a lot of disruption in the short term because you have to reorganize the way that you do your back office functions. You need to outsource some of that. You need to rework the interfaces between your back office and your core business, and doing all of that in a short space of time is a nightmare.
It has cultural ramifications and
the problem is that it can really disrupt the business.
Yes.
Trying to do it fast is not really a recipe for success. So if you have already a point of view that you need to be lean, you're going to be doing that on a gradual way. Yeah, okay, we don't need as much back office support. Maybe we can outsource some of that. Maybe we should reorganize the way that we work. Maybe we can streamline the interface. But you're going to be doing that throughout a period of time. Yes. If you try to do that in a couple of months, chances are you're going to cause more disruption than it's going to benefit you.
So what you're saying is baby stepping.
Yeah, and then having a flexible workforce, you need to have people who can, for example, in our case, who can work as well in projects in Norway as they can do in the projects around the world, halfway across the world. People who are experts in developing projects, in operating projects, who are experts in making operations as lean and as efficient as possible. So if you have a flexible workforce in that sense, people who really know what they're doing, how they're doing, and how to take whatever they're doing from one place and apply it elsewhere, that's where you can search for efficiency across your business.
So it's being able to transfer skills, it's the mobility.
And transfer knowledge as well. Yeah. I think that's the key point. It's not only a matter of taking someone from one part of the business and just shipping that person elsewhere, because that also can be very expensive, but it's about how can you use that person's knowledge from one part of the business, from one type of operations, and how can you reapply that elsewhere and take the best practice, take the learning, and make sure that you are being as efficient as possible in another part of the business. Yes. And it's about also looking for efficiencies and looking for lower costs as a mindset, as a mentality. So you are always trying to benchmark yourself. You mentioned some of the benchmarks in terms of project execution. Yes. You're always trying to look for improvement opportunities. I think that is what I mean by having a lean, flexible, and efficient workforce.
This is a mindset, always looking for improvement opportunities rather than waiting for an external shock to trigger improvement initiatives.
Yeah, I think that there's an interesting point. When I was here at the school, there was always this saying about, okay, don't let a good crisis go to waste. Yeah. And people like to say that. But I don't think you need to wait for a crisis to actually start doing something. And that has been our mindset. And what we see some of our peers in the industry struggling with this point. Yes. They have waited for an external shock to trigger some of the housekeeping that they should have done before.
Because it's just accumulated, isn't it?
Yeah, and that forces external pressure on the company as well. You mentioned about shareholder return. Yes. That is now a key word that we see in the industry. Even though the European companies are not faced with so much external pressure as the American companies, but we can use what's happening in the American companies
because of the shale revolution
as a good proxy for what we need to do. Not only the shale revolution, but if you looked at what happened in some of the American oil companies in the past 6 months or a year, lots of them were faced with serious shareholder activism, demanding that not only the executives and the CEOs reined in some of the executive pay, but also that the companies return more value, more dividends, more value to shareholders. Then that triggered a wave of portfolio management. They divested lots of their assets outside the US. They reinvested the procedures in shale because that's where they could get a competitive advantage. They increased their dividend policies. Lots of them did share buyback. So there was, and there still is, a lot of external pressure being applied in the industry. And that whole topic about external pressure this is a global industry, a geopolitical driven industry that is always faced with challenges coming from the external environment. But I think there is something interesting going on right now, which is more than ever, the people working on the industry, they have to be attentive, and they have to know the big picture. They have to know about not only about shareholder activism, about bottom line, about cash flow to cover dividends, about mega projects, but they also are having to talk a lot more about sustainability, about there is an ongoing debate about what we call a carbon bubble or unburned resources.
Yes.
There is an ongoing debate about resource efficiency. There is this debate about how technology can disrupt the business. So there is a big change, a big shift now, I think, in the profile of people also working in the industry, whereas before you might argue that it was a very technical-driven industry. People, and in some sense it still is. You still need a lot of very smart engineers and geologists working in this industry. But also now you need a lot of smart people that can understand about the external environment and can articulate it well, and can translate the external environment and get the trends and get the trade-offs and the challenges and the issues, and use that knowledge, use that big picture, use that thinking process, and articulate that and translate that into what does it mean for our strategy, what does it mean for what we need to do.
This is very interesting because, you know, the traditional view of strategy is you do an analysis and then you start implementing, and now what you're saying is it's very multifaceted. It's about being able to sense what is happening outside in the environment and then articulate it and then communicate it in the organization, and having an organization that can do something with, you know, what's been translated and what comes in.
Yeah, and communicating and engaging and again, and translating this complex and uncertain external environment into actionable projects, initiatives, and direction for the company. That is a key skill that's needed out of people also coming into.
But what that also means is, contrary to, you know, how the oil and gas industry works, it's about being less conservative.
Yeah,
it's you know, it's being open-minded and prepared to accept, you know, realities and paradigms that previously you were not prepared to.
Yeah, and I think that there is still a space for being conservative, and you're not going to not be conservative when it comes down to safety, when it comes down to security, when it comes down to your impact on the environment and so on. So there is a space for, in a way, to being conservative. You don't want someone to be too innovative on the way that they handle security, for example. So security is paramount. The safety of our employees, of our workforce, is also paramount. Minimizing the impact on the environment is key. But if you go outside of those core and the key beliefs and the key commitments that the industry needs to have, there is a lot of space for people to, in a way, think outside the boxes, or outside the box of how you can not only use technology, engineer things, but also how can you design commercial agreements, how you can negotiate commitments on engagements with stakeholders, how you can relate to your peers in the industry. I think there's a lot of space to become less conservative and less tied to old models and trying and new models. And the key word is that in an environment where the uncertainty is very high, you need to be flexible and you need to allow yourself to have options going forward, because you don't know what's going to happen.
You see, the key point for me, takeaway on this, is having the ability to think outside the box, and an organization and a culture, an organization that allows people to think outside the box, rather than, you know, putting you in a straitjacket, and allowing that creativity to flourish.
And again, bigger companies, and especially industrial companies, they tend to have too many processes and too many workflows, and too many directives on how work should be done. Which is fine. You need a structure to be able to say, okay, that's our structured way of developing a mega project as well. Okay, but do we actually need to develop it exactly like that, or can we develop can we use a different concept? Can we use a different commercial contractual model?
Yes.
What is it that we can do to allow ourselves not only to build value in the short term, but also to have options going forward in case the environment change. And then that's the only thing that we know as well. The only thing that we know is that things are not going to be the same going forward,
yes.
either on the short term or in the medium term, or in the case of this industry, some of the projects are measured in decades. We believe that demand for oil and gas is still going to be there 50 years from now, and it's still going to be core of the energy needs on a global scale.
Yes.
Again, people might argue about that or not, but that's a core belief. So if we know that, but we have no idea what's going to happen in the short term.
Short term, yeah.
Price go up, price go down, there are probably going to be geopolitical shocks, there are probably going to be technological shocks. If you don't have a workforce that knows how to keep their core beliefs, but also how to be flexible where they need to be,
yes.
and trying to optimize things where they need to be, but take into account the safety, efficiency, environment, you're not going to be able to compete. And I think that's the key point. It is increasingly a competitive environment. And the ability to be at the same time flexible and efficient is going to be the key challenge going forward.
Being able to balance the two. Okay, one final point, Julio, is you mentioned to me that someone within the Statoil strategy team had written this article on shale in the US, and we have to be careful when we talk about an average break-even price for shale development. Can you just explain, a bit more what that article was about?
Yeah, I think there was an interview by John Knight. John is is our executive vice president, head of the global strategy and business development at Statoil.
Yes.
He's also part of the executive committee of the company. I think he gave an interview saying that we need to disaggregate this discussion about break-even when it comes down to shale oil and gas or shale projects in the US, because you can as well use the picture that's on the cover of The Economist and shakes versus shale, and saying, oh yeah, OPEC is playing the chicken game with the shale and seeing who blinks first. That is a simplification. The same way that you have OPEC countries that are also on the brink of going bankrupt, like Venezuela, for example. You also have different shale operations that have very different break-even prices that will enable different people also to cope with low oil price. So the same way that Saudi Arabia, for example, is saying, well, we can cope with much lower price than that, and we are not going to cut our production, let's see what happens, and the market will stabilize. Yes. If you go to the US, if you go to the shale operations, you have different companies, most of them independent players that have very different realities in the different projects that they have. You have projects that have very high break-even price.
Such as?
For example, if you have a dry gas only project in a part of the country that doesn't have a very good distribution network, the price paid for your product is going to be low, hence your revenue stream is going to be low, hence your break-even price for the project, and your extraction costs are going to be not as efficient. Or if you have a very difficult shale to produce,
yes.
That needs a lot more wells, and then your costs go high as well. It depends a lot on the geology, depends on how many wells you need to drill, it depends how much production flows from your wells. It depends also on the market side of the equation. Or, for example, if you have a project on the, let's say, the Eagle Ford. The Eagle Ford is one of the most profitable shales in the US because it has a very high liquids content, and it's sitting on a core market in Texas. They can both export it, they can send it to the refineries in the Gulf Coast. It's easy for them to have the market, and also the production, the crude being produced from the shale is also very light, which means that it's It's very easy to refine, and it needs and it achieves a very high price.
Yes.
So the break-even price can go all the way from $80 a barrel for the worst types of shale or the worst projects.
Onshore 48?
Sorry?
Onshore 48?
Yeah, that's for the onshore shale project. It can be very high in some parts of the project, and it can go all the way down to $40 a barrel or $35 a barrel in the best parts of it. And sometimes the companies, they have a portfolio of projects, even sometimes on the same shale, where on what they call the sweet spots, on the best producing parts of the shale, the break-even is very low.
Yes.
And on the worst ones, the fringes, then the break-even price is quite high. So trying to aggregate everything and say, oh yeah, break-even for shale is X, doesn't really help.
So you can't have a broad brush. So you can disaggregate, and there are winners and there are losers.
Yeah. And not only that, but there are some companies who have hedged their production for the next couple of years.
Yes.
Those companies are going to be more insulated from lower oil prices than companies that don't have a hedge on low oil price. So the companies that have hedged, they can manage to lower the production and withstand this lower price environment for a year or two. There are others that don't. They might need to start selling some of their assets, some of their projects, because they are completely exposed to lower revenues. And most of those companies are also, they have different sizes of debt on their balance sheet. Right. The worst ones, they probably have a higher debt to equity ratio, and again, they'll be more exposed to either having to sell assets to cover up some of the debt, or being taken over by a stronger company. And the ones that have lower debt in their balance sheet, they probably can withstand a year or two of low oil price environment before having to do something more radical. So I think that's the point. It's not about shale, it's about which shale, which project, who is doing it, how the company looks like, what's the break-even part in that particular project, and then you can start understanding about the true impact of a low oil price scenario on the shales in the US.
Very interesting.
Yeah.
Okay, so that was very insightful. I'm here with Julio Dal Poz from Statoil's strategy team. Thank you very much.
Well, thank you, Roger.
Thank you.